I really liked one concept which was novel to me, and it's the concept of the upside of bubbles. Could you expand on that so our audience understands that a bit better?
Well, I am not a technologist. And so to write a memo about whether AI could be a bubble,
Yes.
I had to learn a lot. And my son Andrew, who uh, is a technologist and a forward thinker, gave me a bunch of stuff to read. So I read the books and I cite them in the memo. By the way, we're talking about memos, David. I
Yes.
hope that your audience knows that anybody who wants to can get the memos at
Right.
oaktreecapital.com. Sign on, click on Insights, click on Howard Marks memos, and they can get all the memos they want, and they're all free. So some of the readings that Andrew gave me were from books about bubbles, and they're cited in the memo, so you can find them if you're interested. And what they basically said is that everybody's worried about bubbles, but there's actually an upside to bubbles. And the upside is that the excitement that surrounds this technological innovation is so strong that money is committed and the thing, whatever it is, gets built out very fast. And I found this very interesting, and I think it's correct. And what I say in the memo is that, when you have these bubbles, and you had a bubble in railroads in the 1880s, and radio in the 1920s, and internet in 2000, or optical fiber in 98, etc. When you have these bubbles, if people remained objective and prudent and skeptical and demanding and risk averse, it would take a long time for these things to get built out. But because of the enthusiasm or excitement that surrounds the bubble, they get built out much faster than they otherwise would have. So that's the upside of bubbles, that they
Mm.
accelerate technological progress. But of course, remember, these books are written by technologists, not investors. So
Yeah.
the technologist thinks about this and says, oh, bubbles are great because they accelerate progress. The investor says, not so great. I could lose money. The technologist is not concerned about the fact that people could lose money because of the beneficial effect on society. But anyway, I do think that in some way that is a beneficial effect of bubbles, that they get stuff done fast. A bubble is a burst of enthusiasm. In 1996, Alan Greenspan, Fed chairman, coined the phrase irrational exuberance. And so what I say in the memo is that a bubble is irrational exuberance. And you look at AI today, there's exuberance. The question is whether it's irrational, but I can't tell you that because I don't know how AI is going to end up. AI conceivably, it's not impossible that
Mm.
AI will justify today's enthusiasm. So that's why I can't tell you whether it's a bubble or not.
Great. Yeah, and speaking of bubbles, you also wrote about bubbles in January this year on your memo on Bubble Watch. And you made a point that the forward returns for the S&P based on probabilities and historical data are likely to be lower
Yeah.
than the short-term historical run. So if you could reweight the S&P however you wanted, how would that change that outlook in your opinion, or how would you approach that?
I think that to be a representative index of 500 stocks, it's not good that 7 of them are 40% of the index. So you probably would not weight the stocks based on their market value, which is what it is today.
Right.
Maybe
Right.
you'd weight it on earnings or something like that. Or maybe you'd do equally weighted. but it's not much of a 500 stock index if seven of them are 40%, right?
True.
1.4% of the stocks are 40% of the index. That's not very representative. But other than that, I mean, the interesting thing, which I mentioned in another memo earlier this year, is that the seven stocks, the so-called Magnificent Seven, are overweighted, but not insanely expensive. I mean, they have PE ratios, which is the main metric for expensiveness valuation. They have PE ratios in the 30s. And that's high, but not crazy, in my opinion. These are great companies. And I would, if I had to opine, which I don't have to do because it's not my business, but if I had to opine, I would say that the Nifty 50 are not overpriced at 30 something times earnings. When I came into the business as a young man at age 29, when I got out of Chicago, there was a bubble in what were called the Nifty 50, the 50 best and fastest growing companies in America. And they were selling at PE ratios between 60 and 90. So 30 doesn't seem very expensive to me. You see where I'm going.
Right,
And,
right.
but what I think is high is the PE ratio on the other 493 companies, which averages around 20 or 19. The historic average for the S&P is 16, and that includes the highest valuation, highly represented, overweighted stocks. So obviously the not highest valued, highest represented stocks, PE ratios might have averaged 14 or 15, and today they're close to 20. So that seems very high to me. Anyway, that's kind of a sidetrack, but that's the way my mind works.